Hi, I'm Tom Mihawk. Welcome to the Personal Finance course and this chapter about life insurance. When I teach this chapter face to face, I ask students, why do we need life insurance? What's it for? What's its purpose? Is it worth it? How much should it cost? Do I need it? When should I get it? Well, let's take a look at some of these questions. Let's look at the degree of impact from life events. Notice that the death of a spouse is the most impactful event, the most negatively impactful event that life could deal you, followed by divorce, marital separation, and imprisonment, and then the death of a close family member. The top five of the top five, two include deaths. So death is clearly a very impactful thing in people's lives. Death impacts a family and loved ones, dependents, and business partners. It causes grief and emotional distress, financial struggle, or even financial failure. A surviving spouse must now raise children and provide for the family themselves. Maybe before they were able to do it with the spouse together, but now they're doing it alone, and that can be a big challenge. It might mean someone needs to go back to school, get a graduate degree, go back to law school, retrain, and just get more undergraduate training. It may have a significant investment, tax, or estate planning implications also. If insurance planning wasn't done properly, these investment, tax, or estate planning issues can affect you greatly. In a business, it can be devastated by the loss of a talented, important employee. If there are three partners in a business, one CEO, one chief operating officer, and one head of sales, and the head of sales passes away, the CEO and the chief operating officer might not be nearly as good salespeople as the salesperson was. And so the loss of that head salesperson can be extremely impactful. And lastly, in a family business, the heirs may have less or little skill and be unprepared to assume the role that the deceased family member held. In a family business, a death can be crippling. So what's the planning need for life insurance? What's the purpose of life insurance? Well, the purpose of life insurance is to replace lost earnings so survivors can continue to live the way they do now. We're going to talk about this later, but the question I first ask clients when I'm advising them is, if you should pass prematurely, how do you want your family to live after you've passed, your surviving family? Most of the time, almost every time, people say, I want them to live the way they do today. I want them to live the way they do now. And if that's the case, that provides the planning scenario to include life insurance in certain ways. So some of the things you might look at: paying off debt, enabling a stronger financial position for your surviving family, funding future plans like college for children. And these things might not have been able to be paid if there wasn't income, the income, of course, lost by the deceased family member, or savings. In a business, it can provide cash for business operations or to demonstrate a stronger financial position. Suppliers may want this, or customers may want to see additional cash in the company if an important business person has been lost. It can also provide cash to replace a lost executive, meaning it can be used to hire a recruiter to find a new executive, or it can be used to provide some time to operate without the executive and until, maybe less efficiently, but the cash can be very helpful, until an executive can come in and be replaced. And it can provide funds to purchase the deceased business person's interest. I work on this a lot with families, in particular where families are married, business partners are married, and if one business partner passes, the spouse may be told, well, we'll buy their interest in the business, but we'll buy it out of business operations. And how long might that take? 3 years, 5 years, 10 years? In the meantime, the surviving spouse might be raising children, trying to put them through college. So the important thing is that insurance can be used to provide immediate cash to the surviving partners to buy the deceased partner's interest in the business. The benefit is that cash immediately can go to the deceased partner's spouse and give them the ability to receive cash for their business interest of the deceased spouse. So, what is life insurance? Life insurance is a contract. It's issued by an insurance company, or sometimes we call them carriers. It's a contract. It's basically a piece of paper. Now, it's a promise too, but it is a contract. It's a contract with an agreement to pay a financial amount called a death benefit or a face amount in the case that someone passes away. And we're going to describe the terminology for these benefits in a moment and who these parties are. But the payment goes to a beneficiary, and the beneficiary receives the death benefit upon the death of the insured. The beneficiary presents a death certificate, and very quickly after receiving the death certificate at the insurance company sends a check for the amount of the death benefit, and the family then receives the financial remuneration. Having been through it myself with my father, I know that you're grieving, and it's a difficult time immediately after a death, and the ability to and you don't know where to get a death certificate. They seem to be expensive. You have to go to a public authority to get them, and you can only get 5. You can't just get 1. And so you have this death certificate, you present it or send it, probably these days scan it and send it to the insurance company, and then they send you a check for the death benefit. This provides great comfort, the ability to support surviving family members and pay for death, funeral expenses and things like that. In addition, life insurance cash value in an insurance policy receives favorable tax treatment. Now, what does that mean? It means that the cash in the policy that's been paid in the form of what we call premiums, that exceeds the amount of the cost of life insurance, stays in the policy and grows tax deferred, just like in a 401k plan. It's not a 401k plan, but it's like a 401k plan. And in that the money goes in the policy, it stays in the policy and grows without taxation. If later you take money out of the policy, years later, 10 years, 20 years, 5 years, take money out of the policy, and if the policy does not lapse, if it stays in force, you can take that money out with no taxation. And that's a great benefit and an important part of executive benefit planning too, for highly compensated executives, senior executives, and those sorts of things. In fact, half of the Fortune 500 companies use life insurance to fund their deferred compensation plans, and they use it partly for this reason, to get the benefit of this preferential tax treatment. In addition, the death benefit that's received is received income tax free, not estate tax free. So money it's paid to a beneficiary is then potentially in their estate and could be subject to estate tax later. But the receipt of the death benefit is income tax free, and that's very important. It's income tax free. Now, who are the parties to a life insurance contract? First is the beneficiary. The beneficiary is the person who receives the death benefit upon the death of the insured. The second party, the insured, is the person that the life insurance company determines the risk for. They get their medical records, they give them a medical exam, they make an assessment about the risk of insuring them, and on their death, the death benefit is paid to the beneficiary. There's the third party. The third party is the owner of the policy. In general, 2 of 3 of these are the same, and actually they need to be. In general, we have an ethical or moral dilemma if we have 3 different parties for beneficiary, insured, and owner. And guess why? Because if the owner is different from the insured and the beneficiary, the owner and the beneficiary could collude because they have an interest in the death and the demise of the insured. So when the owner and the insured are the same, we don't have that conflict. Or if the beneficiary and the insured are the same, well, that can't be. If the beneficiary and the owner are the same, we don't have that conflict. So 2 of the 3 should generally be the same. 3 parties to an insurance contract. Some background. Mortality calculations or analysis has been done since the Middle Ages, and mortality tables are the tables that allow us to calculate how long someone should live. Today, if you're 60 years old, you are likely to live another about 22 years. I may be off a little bit, but if you live to 65, it's not 17, it's more like 18. So the longer you live, the longer you are likely to live, the longer you're living. Insurance companies don't know exactly who is going to pass, but the actuaries who design products and who go through a 10-year licensing process to become an actuary, using the law of large numbers, actuaries can tell how many will die if the numbers are large enough. So if there are 1 million lives, an insurance company can tell you how many 30-year-olds, how many 40s, how many 50s, how many 62-year-olds will die in any particular year, how many men, how many women. They don't know specifically which ones, but they can tell you by description which ones will pass. And so that's the description for mortality tables and the law of large numbers. How do you know if you need life insurance? How do I know if I'm you? How do I know if I need life insurance? Well, do you have responsibility, financial responsibility for someone else? If you do, you likely could use life insurance in your planning. Are you responsible for, are there financial commitments that if you pass, someone else will be responsible for? Parents, for example, with loans, business partners with loans, a spouse who'd be responsible for your commitments if you pass. Those are indications that life insurance would be an important part of your planning. Or do you have possible financial dependents? Spouse, children, parents, business partners. And then lastly, do you have philanthropic goals or bequest motives? If you do, if you want children to inherit, if you want them to have some social capital, or if you want them to have the ability to buy a home or fund college for your grandchildren, their children, that's considered a bequest motive, and that may be a reason to own life insurance. Also, do you have philanthropic goals? Do you want to give funds to where you went to college or where you went to grad school, or your church or some club? Those are additional reasons to own life insurance. So in general, the way you know if you need life insurance is if you have financial responsibility for someone else, or if someone else will have a financial responsibility if you pass because of your commitments today. Okay? And this is the end of the first section of this life insurance chapter, and I'll see you shortly for the second